Good afternoon, everybody. Welcome to Liberty Call for Tuesday, May 5th. May 3rd, 2022. Hope everyone's having a wonderful day out there in the interwebs. It's a pretty nice day here in the beautiful state of Colorado. It's a little hazy. We got a weather system that's been coming through, bringing us some rain and little snow. I think we're supposed to get a little snow tonight. Nothing too dramatic, but it's the first week of May. You know, these things, I think there's been snow on the ground every year I've lived here. And this is moved here 5 years ago. I guess this week is when we got here and had a big old snowfall that first week we were here. We were flying out to South Carolina to see our youngest son graduate one of his schools in the Navy. And the morning we were leaving, there was, 4 or 5 inches of snow on our cars outside the hotel where we were staying. So anyways, yeah, it's, I'm sure for my friends in Houston, they're like, Jesus, snow, at this time of the year, but it's not uncommon, unfortunately. So, all right. Well, like I said, I hope everyone's having a fantastic day and a pretty good day in the markets. Everything, mostly greens from what I can see. And got some financial news coming out. And boy, there was a leak yesterday with the Supreme Court. And whew, one side of the political aisle is furious. Boy, you'd think they took away their welfare or something, man. Anyways, I'll leave that topic alone. If anyone wants to talk offline, I'll be happy to discuss it. And I find it a little comical that everyone's getting so mad. I mean, really nothing is going to change if, the law, it's not really a law. It was a court decision from 50 years ago gets taken away. I mean, really nothing changes. It's then a states' rights issue, which is kind of the way the system was set up to begin with. So anyways, all right, well, let's go ahead and take a peek at today's market. The Dow Jones finished up 0.2% at 33,128. The S&P 500 up 0.48, closed at 4175. The NASDAQ was up 0.22%, closed at 12,563. Small caps are almost up 1%. The VIX receded almost 10% today. It's currently at 29.25. The other exchanges here in the Americas, Canada was up 1.03. Brazil barely down 0.12. Mexico was down 1.47%. Moving over to Western Europe, Germany was up 0.72. The UK up 0.22. France up 0.79. The Euro Stoxx up 0.77. Netherlands up 1.66. Was that Spain? Spain up 1.83. Italy up 1.61. Again, lots of ups. Those are the major ones. Looks like the Russian exchanges were closed today. I didn't see any news on that, so I'm not sure why. Moving over to Eastern Europe, Budapest was up. Budapest is Hungary up 2.08%. Turkey up 0.09. Moving further towards Asia, Israel was down 0.27. Saudi Arabia up 0.66. Moving over to the Asian markets, Japan down 0.11. Australia down 0.42. New Zealand down 0.44. It appears the Chinese markets were mostly in the green. The Shanghai was up 2.41. The SESE component up 3.69. China A50 up 1.13. The DJ Shanghai, it looks like it was closed. And the Hang Seng was up 0.06 and the Taiwan weighted down 0.56. And some of these smaller ones appear to mostly be red. So all in all, looking at the day, started out in Asia, looked pretty good. Waned a little bit in some of the smaller exchanges in Eastern Europe, Western Asia. And for the rest of the globe, looked pretty good. I mean, there were a few outliers here and there like Mexico and Brazil. But all in all, not a terrible day. So we'll take it. All right, let's go ahead and read the market recap here. S&P 500 climbs as financials, energy rack up gains ahead of the Fed decision. The S&P 500 climbed Tuesday, led by energy and financials as the Federal Reserve kicked off its two-day meeting. Energy was up more than 2% despite weakness in oil prices amid ongoing concerns that COVID-19 lockdowns in China are likely to stem energy demand in the world's second largest economy. March crude production was still comparatively high in China, Commerce Bank citing the National Bureau of Statistics. But that is likely to change in April, pointing to the impact on demand from lockdowns in China. BP jumped more than 5% after the major oil major reported quarterly results that beat both the top and bottom lines. Financials, meanwhile, were also involved in the heavy lifting of the broader market as investor sentiment in bank stocks returned following the recent surge in Treasury yields. JP Morgan, Bank of America, Citigroup were among the top gainers in the sector, with the latter up more than 3%. Quote, "We think the simple story that rising rates are good for banks is still very much in place, particularly the first 200 to 300 basis points of a rate cycle," end quote, Oppenheimer said in a note. Technology stocks, meanwhile, were boosted by a slip in Treasury yields. That doesn't make sense. Technology stocks, meanwhile, were boosted by a slip in Treasury yields slipped. I think they had the word in there twice. But investors remain wary of piling into growth corners of the market at a time when the Federal Reserve is preparing to step up the pace of monetary policy tightening. Probably a good idea. Growth stocks are not real good when the market's probably headed for a downturn, at least for the short bit. The Fed is expected to raise rates by 50 basis points on Wednesday for the first time in more than 2 decades to combat stubbornly high inflation. Quote, "The sentiment around the tech space right now is so poor and so hinged to rates, and then in parentheses, Treasury yields, that even when rates come down, tech stocks don't considerably outperform," David Wagner, portfolio manager at Aptus Capital Advisors, told Investing.com in an interview on Tuesday. Meta Platforms, formerly Facebook, led the decline in big tech, falling 6%, while Google, parent Alphabet, Amazon, Microsoft, and Apple were also in the red. Chip stocks gave up gains to trade roughly flat, but are expected to come into added focus after the closing bell as AMD delivers quarterly results. On the earnings front, Pfizer and Expedia garnered the bulk of investor attention. Pfizer was up more than 1% as better than expected first quarter revenue and earnings helped offset softer guidance on the company's COVID-19 Paxlovid. Expedia slid more than 13% after the travel booking company reported mixed quarterly results and expectations that most of the upside from the rebound in travel demand are priced in. Quote, "The company remains well positioned to benefit as developed market travel rebounds. However, we continue to believe both a strong recovery as well as future margin expectations is fairly baked into shares," RBC said in a note. All right. So again, kind of mixed. Some things were up, some things were down. But I think a lot of people are just kind of waiting out to see what the Fed's going to do. I mean, they've kind of telegraphed, where this is all going. So I'd be shocked if they do anything different than what's already been talked about. All right. Record high U.S. job openings, resignations likely to fuel wage inflation. U.S. job openings increased to a record high in March as worker shortages persisted, suggesting that employers could continue to raise wages and help keep inflation uncomfortably high. The Labor Department's Job Openings and Labor Turnover Survey, or JOLTS report, on Tuesday also showed a record 4.5 million people voluntarily quit their jobs, underscoring the growing wage pressures. The government reported last week that compensation for American workers notched its largest increase in more than 3 decades in the first quarter. Quote, "For the economy, this points to another strong jobs report on Friday, and for workers, this means continued strong wage increases, especially for those who changed jobs," end quote, said Robert Frick, corporate economist at Navy Federal Credit Union in Vienna, Virginia. Quote, "The situation likely will continue well into this year, given the Federal Reserve's efforts to cool the labor market probably won't gain traction for months," end quote. Job openings, a measure of labor demand, rose by 205,000 jobs to 11.5 million on the last day of March. The second straight monthly increase lifted job openings to the highest level since the series started in 2000. The retail sector led the rise with an additional 155,000 unfilled jobs. Manufacturers of long-lasting goods reported 50,000 more vacancies. But job openings decreased by 69,000 in transportation, warehousing, and utilities industry. State and local government education had 43,000 fewer vacancies, while job openings in the federal government decreased by 20,000. Yeah, we should probably get rid of all those federal jobs. They're just a waste. We should do everything at the state level, get rid of the federal government altogether. Job openings increased in the South, but fell in the Northeast, Midwest, and West. Economists polled by Reuters had forecast 11 million vacancies. The job workers gap, which Goldman Sachs argues is a better measure of labor market tightness, widened to 5.6 million from 5.08 million, accounting for an all-time high of 3.4% of the labor force, or up 0.3 percentage points from February. According to Goldman Sachs, narrowing the gap halfway by 2.5 million would be enough to slow the fast pace of wage growth. The JOLTS data is being closely watched by the Federal Reserve, which has adopted an aggressive monetary policy stance as it battles skyrocketing inflation, with annual consumer prices surging at rates last seen in 40 years. The U.S. Central Bank is expected to hike interest rates by 0.5 percentage point on Wednesday and likely to start trimming its assets holdings soon. The Fed raised its policy interest rate by 25 basis points in March. Stocks on Wall Street were trading higher. The dollar fell against a basket of currencies. U.S. Treasury prices were mostly higher. Quote, traditionally, the Fed has concentrated on unemployment as a measure of number of workers who can't find jobs, said Lou Crandall, chief economist with Wrightson ICAP in New Jersey, or Jersey City, New Jersey. Quote, in today's environment, the Fed is more focused on the number of firms who can't find workers. The Fed's near-term policy goal is to slow aggregate spending enough to reduce the excess demand for labor, end quote. The job openings rate climbed to 7.1%. That was up from 7.1 in February and matched December's all-time high. The job openings rate increased in establishments with 50 to 999 employees, but declined in businesses with less than 50 workers. Hiring fell by 95,000 jobs to 6.7 million in March. Modest increases in manufacturing, professional, and business services and leisure and hospitality were offset by declines in financial activities, education and health services, government and trade, transportation, and utilities. There are now 70% more jobs available than new hiring. There were a record 1.92 jobs per unemployed person in March. Quote, the persistent difficulty that employers have in filling positions will push wages higher and spur employers to automate operations to find other efficiencies to make do with smaller staffs, said Sophia Koropecki, a senior economist at Moody's Analytics in Westchester, Pennsylvania. Quote, these challenges will only grow more as more baby boomers leave the workforce. Companies will open operations in parts of the country with more available workers, or at least will rely more on remote workers who reside in areas with better demographics, end quote. With jobs abundant, workers are quitting in droves. Quits increased by 152,000, lifting the total to a record 4.5 million. They were concentrated in the professional and business services industry, where resignations increased by 88,000. In the construction sector, quits rose by 69,000. The number of quits increased in the South and the West. The quits rate climbed back to an all-time high of 3%, scaled in late 2021 from 2.9% in February. The quits rate is viewed by policymakers and economists as a measure of job market confidence. The higher quits rate suggests wage inflation will likely continue to build up as companies scramble for workers. Layoffs increased in March, but remained at low levels. The layoffs rate held at 0.9% for a third straight month. So again, I personally view this as an energy cost problem, and that's really where all of this is stemming. Now that people, employers are having to pay more to get more, to get someone into the same job. People are jumping around from place to place. So again, it's not really surprising. I imagine once the economy starts to slow down and falter, and we're, in the midst of recession at some point here in the future, that, layoffs will increase because the companies that are beginning to fail are going to have to get rid of their workforce. And, those companies will then either go out of business or be absorbed by profitable ones. That's how the business cycle works. All righty. One last article here. 9 signs you are not financially okay to retire. Being ready to retire means more than being ready to stop waking up at 6 a.m. to put in long hours at a job you're not thrilled about. If it were that simple, most of us would retire at 25. What it really takes to retire is a solid grasp of your budget, a carefully considered investment and spending plan for your life savings, debt that's under control, and a plan you're excited about for how you'll spend your days. With that in mind, here's 10 signs you might not be ready to retire yet. Struggling to pay current bills. It goes without saying, if you're struggling to pay your bills with a paycheck from work, retiring won't make things easier. As a general rule, retirees need about 75% of their pre-retirement income to enjoy a comfortable retirement. That income typically comes from Social Security, pensions, 401ks, IRAs, and other savings. Will those sources give you enough income to meet your obligations and enjoy your free time? Quote, communicated costs and dry cleaning expenses will decrease, or I'm sorry, commuting costs and dry cleaning expenses will decrease, but entertainment and travel may increase, says Margarita Cheng, CFP and Chief Executive Officer of Blue Ocean Global Wealth in Gaithersburg, Maryland. In addition, quote, it's important to take taxes and healthcare expenses into consideration, she said. Your Social Security check may be taxable depending upon your overall income. Most pensions are taxable. Withdrawals from 401ks and traditional IRAs will also be taxed. And without a job, you will not have access to employer-provided health insurance at favorable group rates. If you're 65 or older, you can enroll in Medicare, but Medicare is not entirely free. It only pays for about 80%. So you're going to have to make up the other 20% difference. Number 2, high debt level. Large amounts of debt will severely strain your savings once you retire, says David Walters, a CFP and portfolio manager with Palisades Hudson Financial Group in Portland, Oregon. Quote, if you can reduce or eliminate credit card payments or car loans, depending upon your situation, paying off your mortgage or downsizing may help you in the long run, he says. Paying down debts before you retire might mean working more years than you'd prefer, but it will likely be worth it for the sense of ease that comes with not having all those monthly payments hanging over your head. Getting rid of debt, including your mortgage, also means getting rid of interest payments that can take a toll on your long-term finances. That being said, it's tough to know what the best use of your money is when you're facing a choice between putting that money in your retirement account or paying down debt. For a loan with an interest rate equal to or higher than what you're likely to earn in the market, say 6 to 8%, you'll get the best return and a guaranteed one at that by paying off your debt. If it's a choice between paying 3% in a mortgage interest, which may be tax deductible if you itemize, and saving more for retirement, the latter is probably the smarter option unless you have a poor investment track record. Number 3, no plan for future major expenses. Quote, you don't want to wait until you're retired to address major foreseeable expenses such as replacing your roof, repaving your driveway, purchasing a vacation home, or buying a new car, says Pedro Silva, a financial advisor and chartered retirement planning counselor with Provo Financial Services in Shrewsbury, Mass. Quote, these larger expenses can add up, especially when funds are withdrawn from taxable accounts and taxes need to be paid on every dollar, end quote. Quote, we encourage clients to tackle large expenses before retirement because of the impact to their portfolios can be significant, he says. Suppose you need a new roof, $7,000, a new driveway, $4,000, a new car, $10,000 down and $300 per month. These purchases, which require $21,000 upfront, mean you have taken nearly $28,000 pre-tax withdrawals from your retirement account if you're in the 24% federal tax bracket, Silva explains. Plus, the $300 per month car payment will cost you $400 per month in pre-tax dollars, and that could represent a significant chunk of your monthly Social Security income. Number 4, unknown Social Security benefits. While you may not be relying on Social Security to meet most of your expenses, you shouldn't ignore it either. If you're like most people and haven't yet estimated how much your benefit will be, the Social Security Administration offers a handy tool to help make that calculation. Walters adds, if you haven't reached full retirement age for Social Security, the age in which you can collect the maximum Social Security monthly benefit, you might want to postpone retirement until you do. If you start claiming Social Security at as early as age 62, monthly checks will be 30% smaller than if you wait until your full retirement age. If you keep working those 4 or 5 years, not only will you receive a larger payment each month just for waiting, you might further increase your payment by adding more high earning years to your benefit calculation. You'll also, of course, have a few more years of paychecks to squirrel away for retirement. Number 5, no monthly financial plan. Once you retire, paychecks stop arriving, but bills keep showing up. Walter says you need to map out your monthly cash flow before you retire, he adds. Planning your monthly cash flow means considering when you will start drawing Social Security benefits and how much you'll receive, in addition to how much you'll withdraw from your personal retirement accounts and in what order. If you have both traditional IRA and Roth IRA, for example, you have to think about the taxes and required minimum distributions on your traditional IRA withdrawals and how that affects your Roth IRA withdrawals, which won't be taxed and aren't subject to RMDs. Having a monthly plan also means having a solid grasp of your expenses, says certified financial planner Kevin Smith, executive vice president of wealth management for Smith, Mayer, Little in York, Pennsylvania. Ideally, you should have 2 to 3 years of actual spending history summarized by category. and you should analyze each category to determine how it might change during retirement. Quote, some expenses may go down, such as debts that may be repaid, whereas others, such as healthcare costs or travel and recreation expenses, may go up, Smith says. Shh. Knowing what your expenses will likely be means knowing how much income you'll need. Once you know how much income you'll need each month, you can address whether your nest egg is large enough to allow you to retire or whether you'll need to keep working and saving and or cut your anticipated retirement expenses. Number 6, no long-term financial plan. Quote, you should understand how long your savings will last and what spending level you can maintain over the coming decades, Walter says. Quote, no one knows exactly how long they will live, but expanding lifespans and increasingly high costs of long-term care may mean your portfolio will have to last longer and stretch further than you once thought, end quote. There's a debate about how much you should withdraw from your portfolio each year. The popular 4% rule says you can tap 4% of your retirement assets each year, is projected to allow your money to last at least 30 years in most scenarios. And you need to plan your retirement to last 30 years or more, Smith says. Quote, based on actuarial statistics for a couple retiring at age 65, there is a 50% probability that at least one will be living at age 92 and a 25% probability at least one will be living at age 97, end quote. Depending upon your health, your portfolio composition, and your risk tolerance, you'll need to come up with a plan for the percentage of assets you'll spend each year, which might mean getting help from a professional financial planner. I know a guy. This guy. Anyways, so I'm not big on the 4% rule. I kind of like the 3% rule. I like to, err on the side of caution. To me, it makes a little more sense to be a little more safe. Plan, when I'm doing a financial plan, my goal is to try and break it and come up with the worst possible scenarios and see if, we can stress test the situation to make sure that if anything I can think of gets thrown at it and there's still money at the end of the day, that's a good problem. All right. Number 7, not accounting for inflation. Inflation will affect your day-to-day expenses and the value of your life savings. An inflation rate of 3%, Smith says, would mean your expenses will double in less than 25 years. It's called the rule of 72. So you take whatever the inflation rate or rate of return and you divide it by 72, and that's the number of years it takes to double. So in this case, with let me bring a calculator over here. So if it took 72 divided by 3%, that's not right. Shit. 3%, so 72 divided by 3, 24 years. So that's the basic math. So for example, if something had a 10% return, rule of 72 says divided by 10, let's say you had $100,000, got a 10% return, it would double every 7.2 years. So that's how the rule of 72 works. All right. Where was I? With average lifespans much longer than they used to be, you need to manage your money more carefully to keep up with or outpace inflation to reduce your chances of outliving your savings. Treasury inflation protected securities, or as we call them, TIPS, will preserve your capital by paying enough interest to keep up with inflation and are considered extremely safe because they're backed by the U.S. government. Well, if anything, we know the U.S. government will never go out of business. To earn investment returns that outpace inflation, look to stocks. Keep in mind that an 8% annual return is really only 5% annual return after 3% inflation. And you got to figure taxes in there too. Avoiding keeping too much in your nest egg in cash and cash equivalents like CD and money market funds. Their interest rates are so low that you'll be losing money. In the short term, you might not notice, but in the long term, you could run out of money sooner than you expected. Number 8, not rebalancing your portfolio. Taking a passive approach to investing can work when you're younger and have plenty of years to make up for any market downturns that hurt your portfolio. But as you approach and into retirement, it can be smart to rebalance your portfolio annually. I do it every quarter to focus on income generation and asset protection. The accepted wisdom about retirees should manage their portfolios consist of diversifying, preserving capital, earning income, and avoiding risk. Easier said than done. Diversifying across a variety of asset classes, bonds, stocks, etc., and industry sectors, healthcare, technology, and so on, helps you protect your portfolio's value when the market declines, since one instrument or asset class might be performing well when another isn't. Capital preservation means choosing investments that aren't too volatile, so your portfolio value doesn't fluctuate wildly. Dividends from stocks of big established companies that have long track record of performing well, or dividends from an index fund or exchange traded fund made up of such companies can provide a dependable income stream. And if you're diversified and staying away from volatile investments, you've taken care of the risk avoidance objective. Number 9, retirement worries you. Quote, even if your portfolio is in top shape, you may not be mentally ready to let go of your working life, Walter said. Quote, working takes up a lot of energy, and some people may be anxious rather than excited to consider months and years of unstructured time ahead. If this sounds like you, think about pursuing a second act venture, working part-time or becoming a volunteer for an organization you care about. Walter says, quote, if you just retire without a plan, however, you can overspend in an effort to combat boredom and run through your savings quicker than you planned, end quote. Ching recommends test driving retirement to gain a sense of how much money you will need and where you will feel comfortable living. It may not be feasible to retire in an expensive city, given your retirement savings and current living expenses, but you can empower yourself by getting clarity on your sources of retirement income and understanding your cash flow. Number 10, you still love your job. There's nothing that says you have to retire just because you reach Social Security's definition of full retirement age. Just look at Warren Buffett, who's still working at almost 90 and has no plans to retire. He does it because he loves picking stocks, not to pad his billions in net worth. If you're excited about getting up and going to work in the morning, keep doing it. Working has benefits beyond the financial. A job you enjoy engages your mind, offers social integration, gives your days purpose, and creates a sense of accomplishment. All these things can help you stay healthy and happy as you age. You also might be able to stay on your employer's health plan and possibly get better coverage than you would through Medicare. All right. So, yeah, I do try to stress that a lot with folks who are getting ready to retire, as far as plan out what your day is going to be like. What is your plans on a Tuesday in June? Is it just sitting around watching, The Price is Right and whatever game shows are on in the mornings these days, and waiting for Jeopardy to come on in the late afternoon before dinner? I mean, to me, that's a pretty sad and boring existence. And I just have to look at what my grandparents did. They retired right before I left for the Navy, and or at least my grandfather did. My grandmother was already retired by that point. But, they were super busy. I remember during their retirement years, they were retired from 92-ish till they passed away in 2014. And, you had to call ahead to their house to see if they'd be home, because they were always doing something. They were part of the Elks Lodge near where they lived. And they were always doing something. And, so they had a very busy life. And, even in their golden years. And to me, I think it kept them, kept their minds engaged, and, give them a sense, like they said here, gives them a sense of purpose. And, whether or not it's volunteering for your favorite charity or maybe a part-time job, if you're into construction, maybe working at Lowe's is fun. I don't know. Everyone's idea of a good time is completely different from myself. So anyways, all right. Well, that's everything I had for today. Hope everyone has a fantastic evening. I'll be back tomorrow on Wednesday. And we'll go through hopefully we'll have some news on what the Fed has done. Hopefully it is a 50 basis point lift in the interest rate, and any other news that comes out in the next 24 hours. So hope everyone has a great night, and I'll talk to you later. Adios.